Last autumn, UK house prices reached record levels, with the highest price-to-income ratios since the 19th century. And just at that moment, the Truss Kwarteng budget sent mortgage rates soaring. It was a real shock to the market, heavily reliant on ultra-low interest rates. And this combination of factors was the perfect trigger for a fall in house prices. And at the height of the Truss craziness, it looked like we could see a very real house price crash as mortgage rates topped 7%. But despite the economic pain of higher mortgage rates, at least there was a silver lining that we might return to a fairer housing market, affordable for most households. But after limited falls in recent months, there are some analysts who fear that prices will be kept artificially high and we will be left with a housing market in an even worse state than ever before. We will look at what is continuing to prop up the market and also why it is premature to say the house price crash is over and why there is likely to be further falls in house prices. The past 7 months have seen a partial correction in house prices, with nationwide showing prices falling 5% and 11% adjusted for inflation. Yet March saw the first monthly rise since last September, and it has led some analysts to claim this might be it. For example, Rightmove claimed that demand from first-time buyers is surprisingly strong, despite the higher interest rates, and they remain quite bullish about UK house prices. Well, firstly, there are many good reasons to expect falling prices. Firstly, mortgage rates are at least double last year. The effective interest rate paid by first-time buyers continues to rise. And given a continued squeezing living standards with falling real wages, this is pushing up the percentage of household income spent on mortgages. This has risen to 37% of disposable income and could continue to rise in the coming months. In London and the South, the rise is even more extreme, with 60% of Londoners' pay going on mortgages. Now, this is usually a trigger for a fall in demand, as buying a house becomes unaffordable. The high prices we see also means that even the relatively modest interest rate rises are having a much bigger effect than in the past. At the risk of simplification, 5% is the new 10%, because interest rates have a much bigger effect because we've borrowed so much. If we look at house price to income ratios, we can see they reached a record level in 2022, but have only seen a very small fall in that ratio. House price to income ratios are still much higher than before the 2007 crash. And if we use the ONS measure of house price to income ratios, it's a similar story. So why are prices not falling further and faster? Firstly, just because we would like house prices to fall and become affordable doesn't necessarily mean it is guaranteed to happen. We have to be careful of avoiding wishful thinking. In the UK housing market, there are a few reasons which deter prices from returning to what you might call more normal levels. The first reason is actually political. With an election around the corner, the government doesn't want to go into an election with falling house prices. The negative wealth effect can be a major vote loser. And in a bid to help first-time buyers, the government are proposing a return of the Help to Buy scheme. Effectively, this is a way to try and help people get bigger mortgages and be able to buy despite very high prices. The website Conservative Home actually have a very good article. They quote a government source as saying, "If we can't do anything on housing supply, we're going to have to do something on affordability. So we have to laugh, if only to keep ourselves from weeping." But it does kind of sum up the political disaster of the UK housing market. The government have abolished housing supply targets because of NIMBYism, and the result is a sharp fall in house building and a continued shortage of housing, which only worsens the underlying crisis. And Help to Buy is in many ways a terrible solution to the problems of the housing market, because rather than tackling the cause of unaffordability, it seeks to give a lucky few a very expensive route onto the property ladder. But it just means that first-time buyers are taking out bigger mortgages for longer terms, leaving themselves with higher mortgage debt, something that will only hamper their living standards over their lifetime. So a return of Help to Buy will just delay or push back a more healthy correction to house prices. And by the way, a House of Commons committee declared the government's policy of Help to Buy an expensive waste of money, which only cost for taxpayer money and inflated house prices. Yet support for homeowners and potential homeowners is a key part of the UK's political DNA, and come the election, the main parties are likely to be fighting for the label of being homeowner friendly. But the real policies of being friendly to first-time buyers and renters would involve different strategies to building and increasing supply, not just getting schemes to get bigger mortgages. Another very important reason for the unexpected strength of demand from first-time buyers is a surge in the cost of renting. Rents have increased 11% in the past year, and the result is that despite rising interest rates, many make the calculation it is better to be paying 40% of your income on a mortgage than 40% of your income on renting. With some private landlords leaving the market, renters are facing an acute shortage of available property, and the result has been a fight for getting any kind of rented accommodation, and which has pushed prices even further. So buying a house is definitely unappealing in the current climate of high deposits, high mortgage payments. But the alternative, renting, is still viewed by many as even more unappealing. The housing market has caused a widening of the intergenerational equity, with the result that many parents have been helping their children with renting costs or buying. And if you're giving your support to your children to be able to pay the rent, it is understandable why you'd be willing to give a deposit to buy a house. And this rise in the bank of mum and dad and wealth in the housing market is one reason for the long-term rise in house price to income ratios, and why house prices are being propped up at seemingly unaffordable levels. Home ownership is seen as so desirable compared to other options that there's also been a change in attitude amongst first-time buyers. Increasingly, first-time buyers are choosing longer mortgage terms. I remember back in 2005, I took out a 43-year mortgage, the longest possible. But it does mean that you will have much higher interest rate costs over the term of your mortgage. But it's another way we are propping up the overvalued housing market. And the concern is that it encourages buyers to overextend themselves and make themselves vulnerable to any future rise in interest rates or economic downturn. Another reason to factor into the housing market is that sellers are notoriously reluctant to drop asking prices. And this is mainly psychology. If you get your house valued at $270,000, we don't like the idea of selling at a loss. If you look at, say, the 1990s crash, it took a considerable time for house prices to fall. But the fall and later stagnation in prices lasted a long time. Over 7 years, between 1989 and 1996, house price to incomes fell from 5 to 2.7. It was a dramatic improvement in housing affordability, but it took over 7 years to happen. But it is hard to see anything similar happening today. Another factor limiting nominal house price falls is the fact that we have inflation of over 10%. And although wages are not keeping up, they're still rising by a considerable amount. Now, even if house prices stagnated, inflation is effectively improving affordability, even though it is not so noticeable. Inflation was a big factor in the 1970s and early 1990s house price correction. One final point about the current situation is that although there are around 800,000 homeowners which face considerable rise in interest rates this year as their fixed rate deal expires, it's unlikely to lead to a rise in distressed owners selling. Mortgage criteria were tightened post-credit crunch, meaning that many homeowners will not be forced into selling, even if it does reduce their disposable income considerably. And this contrasts to, say, 1992 and 2007, when the rise in interest rates did lead to higher repossessions and more people selling. One feature of the current market is the lack of homes for sale. Volumes are still relatively low, and this relative shortage is keeping prices higher than they otherwise would have been. However, despite all these factors propping up house prices, it would be a mistake to declare all house price falls are over. Firstly, homeowners will take time to adjust to the new climate of a buyer's market. Secondly, effective interest rates are still rising, and there are credible reports that many households are genuinely struggling to get a mortgage, even with relatively high income and a good deposit. The mortgage rate effect has not been fully felt by homeowners and prospective buyers. There's usually a time lag of up to 18 months. Bank of England stats show that mortgage approvals and mortgage lending are at a low level. Despite a small recovery in the first quarter of this year, excluding the pandemic shutdown, it is still close to the lowest level since 2009. A key factor that will determine house prices in the next 12 months is the trajectory of interest rates. UK inflation has been surprisingly stubborn, staying above 10% for a considerable time. Now, it will undoubtedly fall later this year as energy price rises fall out of the index, but its continued stubbornness may motivate the bank to have one final increase in interest rates, which is definitely bad news for the housing market and house prices. But perhaps more importantly than whether interest rates rise a little bit more is whether this new interest rate of 4 or 5% are here to stay. And if they are, there will be a continued readjustment from not just home buyers, but buy-to-let investors and the commercial market. Finally, the IMF warned that European house prices are vulnerable to disorderly falls as continued inflation makes markets reevaluate interest rates. Empirical models linking house prices to their fundamental drivers point to an overvaluation of 15 to 20% in most European countries. And this is a reasonable view of the UK too, 15% overvaluation given current interest rates and affordability. So in summary, it would be very nice to be able to make a report that the UK housing market will return to a price to income ratio of say 4, like the post-war average. And this would require a 25% fall in house prices in the next 12 months. However, this neat symmetry is unlikely to happen. The house price to income ratio is only one factor out of many. Resistance from sellers, a continued shortage of supply, and the desperate nature of the renting sector are all propping up prices, something that could be even more propped up by a return to Help to Buy. The difficulty with understanding the UK housing market is that there are so many conflicting factors. There are several factors pushing down prices, but equally a few which are propping them up. What I would expect to happen in the next 12 months or so is really two things. Modest falls in nominal house prices, combined with inflation, will improve affordability to some extent. But at the same time, the housing market will become increasingly unequal, with only those with wealth and above average salaries able to buy, and keeping price to incomes ratios higher than in the past. We'll kind of get the worst of both worlds, a stagnating market and many households overextending themselves to buy even at the seemingly inflated prices. From one perspective, the housing market is clearly overvalued. But at the same time, there's this paradox that still a lot of people want to buy into this overvalued market. It's not a recipe for a happy outcome. If you liked this video and found it useful, please check out this one on why the housing market causes so many problems in the UK.